So we have our disclosure language, so we can get past that. So whatever it takes, part two. We went through whatever it takes, part one, with Mario Draghi back when he was the head of the ECB. In 2012, when he issued the first whatever it takes policy, did whatever it was necessary to save the EU at the time. But I think right now we're seeing a world that's undergoing changes the magnitude of which we haven't seen since the post-World War II period, as we're shifting from globalization to more of a fragmentation. Europe and the EU, which have been struggling for a good part of the last decade, are now responding to the political and economic challenges with their second whatever it takes moment. And that was really introduced by Chancellor-in-Waiting Merz, who realized that they needed to release the debt brake and get some investment going in two areas, mainly defense and infrastructure. So they've announced pretty significant spending on a roughly $4 trillion economy, to be doing about $1 trillion of spending in defense and infrastructure over the next several years will be meaningful. And at the same time, the EU has announced a plan for about $800 billion in defense spending, which is massive spend and a massive shift for the European economy and for the European markets. However, it's easier to say that you're going to do this than it is to actually execute, and the transition away from the U.S., which is a big driver for this, will take some time, but I think we're at a very interesting point in time. So if you go back to September of last year, at the September 24th briefing, we talked about Mario Draghi's plan for European competitiveness, and what he said was, we have to be more productive, and there's an existential challenge facing Europe. And he put out this plan, and it got kind of positive reviews, but for the content, but less positive views for its ability to get executed. And we were wondering what it was going to take to really see some action. There were several challenges presented to Europe, some cyclical, some secular. On the secular side, you have the demographic issues, you had other fiscal policy issues, the structure of the European project. All those things were kind of weighing against it. Having a monetary union without a fiscal union was problematic, as we found out. But really, productivity was one of the big challenges. And as you can see, Europe has been lagging the U.S. in productivity for some time. I think it's gotten worse in the last couple of years since the pandemic occurred. And I would actually go back to the great financial crisis, because I think one of the big changes was the way the U.S. recapitalized our banks, and the way Europe did the recapitalizing of theirs didn't give them what they needed to do to get pulled together. And then you had other challenges, such as the ability for mergers and acquisitions to occur from big cross-border institutions that made it a bit more of a challenge. But these were the issues that were laid out by Draghi. He had a full report. Since then, the EU has taken it to heart and has started to introduce, in January of this year, the Competitiveness Compass, which was designed to take the recommendations of Draghi and put it into an actionable plan. And as Ursula von der Leyen highlighted, this is the time. We have all the tools to do it right. Can we pull it together? And if you don't do it now, we're going to have problems, is really the key message. So their Competitiveness Compass really looked at 3 transformational imperatives and 5 things that needed to be done to enable the transformation to occur. It started with closing the innovation gap, that there's a lot of innovation and a lot of innovative talent in Europe, but some of the structures, regulations, and other issues were not allowing that innovation to be fully realized. The second thing was to continue along the decarbonization path that they were taking, but to do it in a way that shifts from an ideological basis to one where you're doing being more practical in how you apply that and how you actually affect a climate transformation that they were trying to do without hurting the economy to the degree that it might have if you didn't have if you had a more practical approach, it would be better. And then the third area that they were focused on was reducing the excessive dependencies, meaning dependencies on Russia for energy, dependencies on foreign markets for exports, and also dependencies on countries like the U.S. for national security, which has become a much bigger issue in the last couple of weeks, although it actually should have been a bigger issue for the last 8 years because Trump was pretty clear on what his goals were for a long time. So those were the three transformational imperatives. To do that, they figured there are 5 things they need to do. One is to simplify the whole process, to make it easier to do business in the European area, to reduce the regulatory burdens, and to start to realize the scale and the benefits of really what is combined one of the most powerful economic blocs in the world, but has not been punching up to its weight because of these kind of enablers that have to be worked through. The second is to act like a single market and get the benefits of a single market instead of acting like a bunch of countries that are put together to say they're going to help each other but not really get the benefits of the scale that you would get from what is combined the world's largest economy. It's also to figure out with the capital market system how you get, again, punched to their weight and have a structure that allows businesses to be successful, to access capital in a market that doesn't have quite the depth of capital markets that the U.S. would have, which is why a lot of capital leaves. I think the other issues were around skills and around the labor markets. Do we have the right skills, and do we have the right quality of jobs, and do we have the right people coming in to do that? And then how do we pull it all together to get the benefits of these economies, which will take big leadership? And I think the challenges that have existed to date were really that everyone wanted to play along with the concept of a European Union, but only on their nation's terms, and now they're faced with the realities that there is an existential threat. If you didn't get it as a European leader from the first Trump administration, you might have gotten it from the attack on Ukraine, or you might have been getting it more from seeing your leading industries get eviscerated over the last couple of years as you lost your export advantage, and now how do you move forward? So I think the idea of pulling it all together, this is the time, whether Europe can do it or not, will require leadership to act differently than they have at any point in time over the last several years, and it will really depend on the leading nations pulling together with each other and then pulling together the other nations to get the benefits of the scale. So a lot needs to be done, but really the big push and the big whatever it takes moment this time was Merz pushing Germany to release the debt brake, and the fact is Germany has the fiscal space to act. As you can see, versus Italy and France, their debt to GDP is significantly lower, moving away from the views that they're going to go back into a hyperinflationary environment that's plagued them really for the last 100 years, and having a way to do it in a more balanced fashion that allows them to get the benefits of scale that their country can do. I think taking some of the financial restrictions off, particularly with Germany leading the way there, will allow the rest of Europe to act better and act more together and to take advantage of the benefits that they have. But failure to capitalize on this time, I think, will create a bigger problem for Europe if they don't pull it together. So I think this is really their time to have a make or break moment. But investors are taking a renewed interest in European stocks, as you can see. They've had lower valuations for some time. For those of you who've been on the calls for the last several years, you know that I've said that the valuations are earned in part because of the mix of businesses driving the economy. The U.S. is a much heavier in tech, which would have a higher valuation. Europe was much heavier in old economy industries like industrials and finance, which were carrying lower valuations. But you have to get the growth to support that, and they weren't seeing that yet. But there is renewed interest in the short term. I don't know if it's sustainable, and I think a lot of that depends on how Europe takes advantage of this time and the gift that they have. China's been a different story, although they both were rebounding quite a bit in terms of their market. I think the foreign investors are less confident of putting capital into China right now. China has to make the transition where they're more supportive of their own economy with their own consumers. And can they make that transition or not? They're doing steps to stimulate, but I think their stimulation is for stability, not for global growth. Unlike what they did in 2000 in the post-financial crisis period, where they were really trying to help the global economy. Here they really need to do a rebalancing. So I think China will be a big player in this area, but I don't think from a contribution of global growth, it'll be quite what it was previously. So I think that is a shift. And I think the confidence of foreign investors going back into China will take some time to rebuild. Is the approach that China took to dealing with some of their leading companies and the heavy-handedness that they might apply to some foreign businesses is still being felt. So I think that the China opportunity is probably not the same as the U.S. opportunity until you have a different relationship between China and the West. And I think that still needs some time to work through. But you can see the returns have been less favorable for the S&P and even less favorable for the Magnificent Seven relative to what the SOX have done, what the DAX has done, what the Hang Seng Index have done. But I think where you go from here is a whole different story, and I would be cautious if you haven't taken advantage of this to how quickly do I reallocate to take advantage of the shift of capital flows around the world. I don't think the U.S. is at an end to its success for a lot of reasons, and we'll touch on them here. I think what came with the Trump administration has been heightened global disorder. But I think the shift that we're seeing right now in the global economy is there are alternatives to U.S. equities, both public and private, that we really haven't seen for some period of time. Europe and China are doing fiscal stimulus while the U.S. is really going through austerity, which is a complete reversal of what Europe and the U.S. were going through for most of the last decade, and I think that has some pretty important implications. But the U.S. going for austerity right now when our debt to GDP is at highly elevated levels, that we have interest costs that are above what defense spending are, this is the time that the U.S. should be reining things in, and it is the time that Europe should be spending more, although I'd argue that they should have been spending more for the last decade. But that is a change that is an important one for them, and if they release the debt brake and allow them to take advantage of this opportunity, I think that'll put Europe on a much better path. But I think what you're going to see is all boats rising now, not the U.S. declining, but less pressure on the U.S. to pull everyone along and more support from the global system. But I think the big thing is you're not just seeing a shift in country allocations, but there are asset class allocations that are occurring right now as well, where a lot of the favored equity and private equity and public equity areas are shifting to where you have choices in, as Mark was talking about earlier, the private credit, even in the traditional U.S. fixed income markets. Moving from 0 to 4 and 5% gives you a real opportunity, as equity valuations or equity returns might not be the same as they were at zero interest rates. Fixed income will have a better opportunity in this environment as well. So I think you can rebalance, but if you haven't made a lot of those moves, I'd be careful about how quickly I adjust, particularly shifting to Europe and China right now away from the U.S., because U.S. equity valuations have come in a lot. If you look at Google, for example, or Alphabet, I believe it's selling it something like a 17 PE, so a 20% discount to the S&P right now. So not the overvaluation that everyone was talking about, because a lot of the froth has come out of the Magnificent Seven. I would say the last thing about how you invest in this environment is that you have the April 2nd reciprocal tariff announcements, which the president is dropping hints on how that's going to flow, and you can't really determine what's going to happen then. But I would just say that he does believe in tariffs in his heart. He thinks that the U.S. has been getting screwed for a long time, and he thinks this is the opportunity for the U.S. to, as Scott Bessett says, reorder the balance of trade in the global trading system that's been unfavorable to the U.S. However, once we do our announcements, you have to wait for the responses of other nations. Are they going to work with the U.S. or not? And I think they're going to have a hard time working with the U.S. because I believe that a big part of the tariff initiative is to help support the tax policies of the new administration, where he needs other revenues to offset, to provide the offset to the tax, lowering of taxes or the tax cuts, particularly if he can't get Congress to say that the $4 trillion of the old tax cuts is not new taxes, it's a continuation of existing policies. So for us, I would say that this is a different world. You have more choices than you did before, but for those who think the U.S. period of outperformance is done, I would say be careful with that. I think there are a lot of reasons the U.S. Has to adopt. I think can't discount what having a different view of fiscal austerity means for the U.S. I think you can't discount what DOGE means for the U.S. in terms of getting our financial house in order. Not that it's going to change the world, but incrementally you can make changes. I think that the idea of big spending out of Europe, you have to be careful about their increase in defense spending. Goldman Sachs thinks it might be around $100 billion a year for the next several years, so maybe 0.5% of GDP. That's not a game changer for them, particularly when their GDP projections are around 1 to 1.5%. But it is a positive shift, and will push things forward in a much better way. But I just think that the pendulum might have swung too much, too fast, too soon away from the U.S. towards these other areas, and be careful if you weren't positioned for that. Making big adjustments now, I'd be more of a gradualist from this point forward. So Mark, we'll stop there. There's a lot coming, and I would say this is one of the periods of greatest uncertainty in the last 5 years.
Even more than exactly 5 years ago?
I think it is. I think it's not quite the same as the pandemic, but certainly everything that's occurred since, including the wars. I think you have so many different forces at play here, geopolitically, economically, and socially. And keep in mind, at the beginning of last year, we were talking about the 70 nations and half of GDP that were having new leaders. Mm-hmm. And how many of those new leaders will be replaced in the next year could be a scene that you're seeing that we might not have gotten through all the political turmoil. So I think there's more to come, and I think in those periods, the U.S. tends to continue to do well as a safe haven, and I don't think the safe haven trade's gone away. So I'm going to leave it there and open it up for conversation and varied opinions.
Okay. Questions, comments? Thoughts?
Steve, I have a question.
Yep.
So in relation to the valuations that you showed with Asia and Europe, what do you think about potentially the weaker dollar, which exasperates the US valuations as being less expensive than they were, while Europe becomes more expensive? And so going forward, after this tight sort of 3-month window, the money flows back into the US.
I think money will continue to flow to the U.S. If things get more unstable, more money will flow to the U.S. And I do think that a lot of the easy money's been made in Europe. I think now you have to really be finding the guys who have real earnings growth going forward, not just multiple pickup. So I think there's some opportunities, but I also think there's still some real challenges in every equity market. But I think you are seeing some more positive shifts and more positive support for business sentiment in Europe, which, if you think deregulation will help in the U.S., re-regulating Europe will be a big boon for businesses there. So I think you have to be careful about getting too one-sided on any of these trades right now.
Michael,
I mean, what's interesting is SA became very bloated today. It exceeded market caps of most of the other companies, but yet SAP is not an innovative company on a relative basis by any means. Something to think about.
I think, I would just say in that area, they are at the forefront of a lot of the secular themes, not the cyclical themes. and those secular themes are looking more attractive. So when you have the pullback in tech spending is, in our view, is not likely to come down. It'll be adjusted, but it'll still be high. So I think that, and electrification is a big play, and reindustrialization, and I think SAP benefits from all those. So I think that's why you're seeing it. They don't need to be the fastest horse. They just have to be the right horse.
So, Michael and then Adam?
Good, great presentation as usual. To the last point on your last slide about tariffs, the Trump administration faces a similar issue with tariffs and the use of tariffs as previous administrations have faced with the use of sanctions. They only work so far as a policy tool. Now, Trump has a bias in favor of tariffs. He loves them. And so it's not simply April 2nd and see what happens with reciprocal ones. Look at his recent, if you import oil from Venezuela, we're going to impose 25% tariffs on you, right? So what happens is, and I won't say it distorts trade, it changes trade. And what will happen is other countries will work to avoid the US, right? So we'll see a certain amount of balkanization. This is not a good thing, period.
It wouldn't be my go-to economic policy either. So I don't disagree with you, Michael, on the efficacy of the policy or the benefits of it. I will say, though, that Trump has brought about change that wouldn't have come about in a very short period if he didn't act as heavy-handed as he did, whether you like the heavy-handedness or not. But it is changing behaviors, sometimes for the better and sometimes for the worse. So I think that's, but I agree with you. I wouldn't be making big changes on my portfolio on April 2nd. I think there'll be a lot of back and forth over the next couple months on tariffs. I do think it sets up for a better second half, both for the U.S. and for the world, but we'll see. Adam?
Good morning, Stephen. Great presentation. Thank you. How come I've got two videos here? The question is, are you still bullish on defense? That's it. That's my question. U.S.
For the longer term, yes. For the shorter term, less so. And we're actually looking at trimming selling one of our defense holdings that's moved quite a bit and is in less favorable areas for where we see defense going forward. But I also think that in the shorter term, the U.S. defense companies will see Europeans trying to support more European companies in the near term. But I think they're going to run into the challenges of finding out that we are more interdependent and interconnected than politicians would like on paper right now, because it would be much easier for them to say we're going to just support our domestic defense companies and that'll be enough for them to stand on them, for Europe to stand on its own. But I think we're not there yet. But I do think two things. One, U.S. government programs need to be reconsidered, which areas you want to play in that are going to be the areas you want to benefit from the future war. But I also think some of the bigger defense companies may see some of their bigger projects and backlogs delayed in getting filled as the government's sorting through how they're going to rein in costs. So I think some of those will work against each other. So I do think Europe will have some benefits as well, but I don't think it's as easy for everyone to just say we're going to leave this program and start a new one. It doesn't work like that. It takes 3 to 4 years to get a program up and running and going with planning and all that. To switch midstream is going to be more challenging.
In 3 to 4 years is an aggressive timeline.
Yeah, they're talking about 5 to 10 years for the European. The defense people are saying it's 5 to 10 years. So,
okay.
But I think it will slow down, and if things work on the margin, as the markets tend to do, and they tend to discount in advance. I think that means that it's more of a challenging position on defense right now than it was even 6 months ago.
Yeah, the biggest challenge for the Europeans will be political will to spend that money. That 600 billion euro that's just air. The only thing they've done there is allow the other countries to raise that debt, but there's no money in there yet.
Yeah, and I think the other problem that Europe might have with the defense industry is the same one they have with the fiscal union. Which country benefits from it? Which companies benefit from it? And is it going to be France and Germany, getting all the big opportunities and everyone else getting screwed, or is it going to be more evenly put out? And that will have an impact on how some of the southern nations and some of the northern nations will feel about participating. So I do think it's not as easy as saying we're going to spend it to get it actually spent and to get a military in place. And another complicating factor right now is Erdogan and what's the role of Turkey going forward in the process. Is I think they have the second largest military in Europe, so their role is going to be one that's going to be very interesting to see play out as well.
And they're a major manufacturer of weapons as well.
And pretty open about where they send them. Andrew Fish, I think was next.
Yeah, Turkey's also got a lot of borders to worry about. No, but back to Europe and your competitiveness chart. So what you described, about Europe. Within Europe, there's non-trade barriers, soft trade barriers, or always been. Countries protect their certain industries or their farmers or whatever. This is something new or more of the same. I mean, I haven't seen anything concrete that other than talking about it, that's going to change the status quo. Have you?
Well, I think that they are talking about it, and that they're talking about releasing the debt brake, and they're figuring out how to increase the spend without violating the debt brakes for them is a major change. I think it will take some time for them to figure out how to do that. They don't have money. It's about how they pull together. I think Europe's biggest problem is Europe, and can they act to get the scale that they have, or do they stay fragmented and not take advantage of it?
Yeah, that's what I meant on your competitiveness chart.
Yeah.
They're definitely gonna go issue more debt than they have, but that's as a whole. But the European competitiveness, the breaking down the non-trade barriers and things and working together, is, I guess, nothing really has changed other than we're talking about.
But I do think what's changed, though, is that they really understand that, or truly believe for the first time, that they can't count on the U.S. And that alone is the change. And that change is going to force them to act differently. How fast they do that, I think, is going to be the challenge. But I don't think I think that's a mindset change that was a critical first step to get the behavioral change to follow.
So I know VJ had your hand up, but I'm guessing, Dieter, do you have a comment on Europe?
Yes.
Go for it.
So as a former German, I watched a lot of German television. That I'm American citizen. I have no German citizen anymore.
Okay, you're still German. Yeah, keep going.
When the World Cup,
I wonder, like 25% of all Americans have sometimes come from Germany.
Singer was Zahner back in the day.
Dieter, when the World Cup's on,
1777.
when the World Cup's on, who do you root for?
When the what?
When the WorldUp's on and the U.S. is playing
In
Germany.
soccer?
Yeah.
In soccer, I'm a German. I want to win.
Oh, see, there
Yes,
you
you're
go.
a German.
All right, so carry
I'm in football, not.
You're
Football,
American.
ice hockey, baseball, basketball.
Always American.
There's a question in there or a comment. Go ahead.
So I'm watching German television. As you maybe don't know, the two parties who are now trying to form a coalition, the Christian Democrats and the Socialists, are so far away And this will be not a stable government for the next 4 years. They're so far away. And I don't think that there will happening anything soon. To build a factory in Germany now or in Europe takes forever. It's crazy. The Green parties are getting in, and now we have left-wing parties all over. Every country in Europe has different governments. Some are moving more to the right, the other going back to socialist. This will take forever. Important is to get the message from the CEOs of the leading manufacturing and big companies in Europe. And they don't think that there will be any mess up with the Americans. Even they are planning to build big factories over here. It's not only the automotive industry, it's a chemical industry. Everybody is moving and saying. So I don't see it so worse, but a lot of people looking in the press, the better governments are doing this. But in terms of business, we see a lot of interesting business, even family office moving money to the US and vice versa.
I do think capital is going to continue to flow here, so I agree with you fully on that. I do think the thought process that they put into the competitiveness compass is actually pretty good. And if you go to the EU website, they have a fact sheet that is worthwhile going through, because part of what they talk about is getting some of the barriers of regulatory barriers that are holding Europe back on companies and freeing them up, particularly around the industries that they think are going to be most hurt by the transition. And they mentioned chemicals, pharmaceuticals, autos, and one other one that I'm blanking on as key areas that they wanted to make sure that they understand the impact of this transition and how they have to support the most vulnerable manufacturing industries.
Sorry, on a long-winded call, but maybe give me 20, 30 minutes?
Mute. VJ, you have to mute yourself.
Okay.
So, Dieter,
Sorry.
Dieter, I think you're right on one hand, but I do think they are trying to address the things that they know are what's holding Europe back. That's Europe-driven, not U.S.-driven. And regulation, getting the right touch on regulation is definitely one of them, and also helping the industries that need the most help make the transition, because you could easily say the manufacturing prowess of Europe would allow them to transition to doing part of what they're promoting, which is creating AI gigafactories over there and creating AI startup, a different startup environment and all that. So there has to be a mindset